In a glass tower in St. John's, Antigua, a single sheet of paper changed hands. It listed what Stanford International Bank actually held in liquid, verifiable assets. The figure on that sheet bore no relationship to the figure the bank would report to its depositors for the period. According to the SEC's enforcement record, the reported return was not measured. It was selected. That is the structural fact this episode examines. A bank that sold fixed return certificates of deposit to tens of thousands of investors did not calculate its investment performance and then set its rates accordingly. The record establishes the opposite sequence. A return figure was chosen first, chosen to make the promised CD yields look plausible, and the books were then assembled to support it. The question is not whether this was fraudulent. A court has answered that. The question is how a number set in a room could be reconciled, period after period, with audited financial statements, a multi-billion-dollar balance sheet, and a regulator's signature. The answer requires understanding why this particular fraud needed a second set of books and what those books were actually doing. Let us begin with the instrument at the center of it, the certificate of deposit. A certificate of deposit is one of the most conservative instruments in retail finance. The depositor hands the bank a sum of money for a fixed term. In exchange, the bank promises a fixed rate of return and the return of principal at maturity. The appeal is certainty. The depositor is not taking equity risk. They are not exposed to market swings. They are lending to the bank, and the bank's obligation is fixed and known in advance. That fixed quality is the entire point, and it is also the structural vulnerability that Stanford International Bank exploited. Because the rate is promised in advance, the depositor does not monitor the bank's investment performance the way an equity investor monitors a portfolio. There is no quarterly mark-to-market that the CD holder is watching. There's only the rate, and the rate is a contract. As long as the interest payments arrive and maturing CDs are paid out, the depositor has no window into how the underlying money was actually invested or whether it earned anything at all. Stanford International Bank, based in Antigua and operating outside the US regulatory perimeter for deposit insurance, marketed these certificates aggressively. The SEC's complaint established the scale. By the time of the receivership, the bank had sold approximately $8 billion of these certificates to more than 20,000 investors. The marketing emphasized two things in combination: safety and yield. The certificates were presented as conservative, liquid, and secure. And yet they paid rates significantly above what comparable conservative instruments offered elsewhere. That combination is the first structural signal. A genuinely conservative portfolio produces conservative returns. The relationship is not optional. Low risk and high yield do not coexist in a stable portfolio, because if they did, capital would flood towards that combination until the yield compressed. Stanford International Bank offered both persistently across years and across changing market conditions. The record shows the bank's reported returns were not only high but remarkably smooth, posting consistent positive performance even through periods when global markets fell sharply. Here is the legitimate baseline. For a bank selling CDs to make good on an above-market fixed rate, its assets must actually earn more than that rate, net of expenses. The bank takes in deposits, invests them, earns a return, pays the promised rate to depositors, and keeps the spread. The model is sound when the investment return is real and exceeds the cost of the deposits. The model is also self-verifying when honest, because the assets are auditable. A custodian holds the securities. A statement confirms them. An auditor traces the reported return to documented holdings and documented transactions. What the SEC's record establishes is that this verification chain did not exist at Stanford International Bank in any meaningful form. The reported investment return was not derived from the portfolio. The portfolio could not have produced it, and so the bank faced a structural problem that every fraud of this type eventually faces. It had to make the numbers reconcile. It had to produce financial statements showing a return that the actual assets had not generated. That is the function of the second set of books. Not to hide the assets, but to manufacture a performance figure and then build a documentary record beneath it. The phrase second set of books is often used loosely. Here it has a precise meaning. There is the reality of what the bank held and what it earned. And there is the constructed financial reporting in which a target return was inserted at the top and the supporting detail was assembled to justify it. The day count skim in this episode's title refers to the mechanism by which the gap was managed and disguised. We will reach it. But first, the architecture. Begin with the portfolio, because the portfolio is where the fraud lived. Stanford International Bank told its depositors and the public that their money was invested in a globally diversified portfolio of liquid financial instruments. Marketing materials and disclosures described allocations across equities, fixed income, precious metals, and alternative investments, managed by a team of analysts and monitored by independent advisors. The structure described was that of a conventional, professionally managed investment fund. The SEC's complaint established that the actual portfolio bore little resemblance to this description. The record divides the bank's assets into what investigators characterized as tiers. The first tier was cash and cash equivalents, a relatively small portion. The second tier was money managed by outside investment firms, also a portion, but not the bulk. The third tier, the largest by far, comprising the majority of the bank's claimed assets, was not a liquid, diversified portfolio at all. According to the SEC, this third tier consisted substantially of personal loans to Allen Stanford himself, of investments in private companies and real estate ventures controlled by Stanford, and of illiquid holdings whose stated values were not independently established. The record found that a large portion of the bank's claimed assets was tied up in speculative real estate in Antigua and in private ventures with no liquid market and no reliable valuation. The complaint alleged, and the receivership later documented, that billions of dollars of depositor money had been routed into these illiquid and self-dealing channels. This produces the first layer of the architecture. Step 1. Depositors bought CDs believing the proceeds funded a conservative, liquid, diversified portfolio. Step 2. The actual proceeds were deployed substantially into illiquid, related party, and Stanford-controlled assets that did not trade and could not be readily valued or sold. Step 3. This meant the bank could not generate the reported returns from its actual holdings and could not freely liquidate assets to meet redemptions if redemptions exceeded new deposits. That third point is the definition of a Ponzi-like vulnerability. The receiver appointed over Stanford's entities and subsequent court findings characterized the operation as a Ponzi scheme in structure. Returns and redemptions paid to existing depositors were funded substantially by money from new depositors, not from investment earnings. The certificates promised a return the assets did not produce, and the cash to honor maturing certificates came disproportionately from the sale of new ones. Now layer in the reporting problem, because this is where the second set of books becomes necessary. A Ponzi structure can sustain itself as long as new money exceeds outflows. But a bank must also publish financial statements. It must report assets, liabilities, and investment performance. Those statements must show a return high enough to justify the CD rates it pays, because an audited statement showing the bank earning 2% while paying out 7% would expose the gap immediately. So the reported return had to be fabricated to a specific target. This is where the cold open scene fits structurally. The SEC's record describes a process in which the bank's reported investment performance was not the output of measuring the portfolio. It was an input, decided in advance. The record established that Allen Stanford and the Chief Investment Officer, Laura Pendergest-Holt, were involved in setting the return figures the bank would report. The figures were chosen to support the CD rate structure and to maintain the appearance of consistent, market-beating performance. Once a target return is chosen rather than measured, every layer of the financial statement below it must be reverse engineered to support it. If the bank reports earnings, say an 11% return on its portfolio in a year when global markets declined, then the asset values on the balance sheet must be inflated to reflect gains that did not occur. The illiquid third-tier assets, the ones with no market price, were ideal for this. A real estate parcel or a private company with no observable market value can be assigned almost any valuation because there is no trade, no quote, no counterparty to contradict the number. The SEC found that the values assigned to these holdings were not supported by independent appraisal and were, in the agency's characterization, fictitious or grossly inflated, so the architecture closes into a loop. Step 1. Choose the return the bank needs to report. Step 2. Assign inflated values to the illiquid assets sufficient to produce that return on paper. Step 3. Because those assets do not trade, no external price contradicts the assigned values. Step 4. The financial statements reconcile, showing a portfolio that earned its promised return, backed by assets carried at the inflated values that the chosen return required. This is why the fraud needed a second set of books, rather than simply hiding losses. Hiding losses is subtraction. This was construction. The bank was not concealing a hole. It was building a fictional performance record, period after period, and the asset valuations were the construction material. The illiquidity of the third-tier holdings was not a bug. It was the load-bearing feature. Liquid assets have prices that can be checked. Illiquid assets have only the values someone chooses to assign them. Now, the day count skim. The title of this episode refers to the granular mechanism by which the gap between promised and actual yield was managed within the reporting. A certificate of deposit accrues interest according to a day count convention, the method by which the bank calculates how much interest has accumulated over a given period. The convention matters because it determines the precise interest figure on every certificate across the entire book. When you control the day count assumptions, the accrual schedules, and the reported portfolio return simultaneously, you control both sides of the spread on paper. You can present a coherent picture in which the assets earned exactly enough to cover the certificates plus a margin, because you set the asset return and you control the interest accrual mechanics. The numbers do not have to be true. They have to be internally consistent, and a closed system that controls all its own inputs can always be made internally consistent. That internal consistency is precisely what fooled the verification chain, which brings us to detection. A fraud of this scale, operating for years across multiple jurisdictions, did not escape every gatekeeper by accident. It escaped them because of specific structural features of how Stanford International Bank was situated, audited, and regulated. Consider each link in the verification chain and where it failed. The first link is the auditor. Stanford International Bank's financial statements were audited by a small Antiguan accounting firm. The SEC's record noted that this firm was not a major international auditor with the resources to independently value a multi-billion-dollar portfolio of complex and illiquid holdings. The structural point here is about capacity and independence. An auditor verifying a bank's reported investment return must independently confirm the existence and value of the assets producing that return. For liquid securities held at a major custodian, this is routine. The auditor confirms holdings directly with the custodian and prices them against observable markets. For illiquid, related party assets with no market price, independent verification is far harder, and a small firm without the resources or the will to challenge management's valuations cannot perform it. The record raises a further structural concern. A small auditor, whose largest client is the entity it audits, faces an economic dependency that compromises the independence the audit function requires. The audit opinion is supposed to be the depositor's assurance that the numbers are real. When the auditor lacks both the capacity to verify the most important assets and the independence to challenge management, the audit opinion confirms only that the statements are internally consistent, and internal consistency was exactly what the second set of books was engineered to provide. The second link is the custody and valuation of the assets themselves. In a conventional fund, the manager does not hold its own assets and does not set its own valuations. An independent custodian holds the securities, and observable market prices set their values. This separation is the structural safeguard. The manager who reports the return is not the same party who confirms the holdings. At Stanford International Bank, the record established that the most significant assets were not held at independent custodians in any verifiable diversified portfolio. They were Stanford-controlled illiquid holdings, valued by people inside the Stanford organization. The separation that makes valuation trustworthy did not exist. The same circle that set the target return controlled the asset values that justified it. The third link is the regulator. Stanford International Bank operated in Antigua under the supervision of the Antiguan Financial Services Regulatory Commission. The SEC's later filings and subsequent investigations raise serious questions about the rigor and independence of that supervision. The structural issue is regulatory geography. By domiciling the bank offshore, the operation placed its primary supervision in a jurisdiction whose regulatory capacity and independence were limited and outside the direct reach of US bank examiners. The certificates were sold to US investors through a US broker-dealer affiliate, but the bank issuing them sat outside the US deposit-taking regulatory regime. This jurisdictional arrangement is itself part of the architecture. It placed the entity that held the assets and reported the returns where the most capable regulators could not directly examine its books. The fourth link is the broker-dealer and financial advisor channel through which the CDs were sold. The certificates reached US investors through Stanford Group Company, a registered broker-dealer and investment advisor. Financial advisors sold the CDs and earned commissions on the sales. The structural feature here is the incentive alignment. The advisors selling the product were compensated on the volume they placed, and the SEC's complaint noted that the commission structure rewarded the sale and retention of these CDs. An advisor compensated for selling a product has a diminished incentive to interrogate that product's underlying claims. This is not a statement about any individual advisor's knowledge. It is a structural observation about where the incentive to verify was, and was not, located in the distribution chain. Now stack these failures, because the fraud survived not because any single gatekeeper failed, but because every link in the verification chain was either compromised or absent. The auditor lacked capacity and independence. The asset custody and valuation were controlled by the same parties reporting the returns. The home regulator lacked rigor and sat in a jurisdiction chosen partly for that reason. And the distribution channel was compensated to sell rather than to scrutinize. There is a further structural point about why detection was delayed even when the warning signs were visible to analysts. The returns themselves were the loudest signal. Consistent, smooth, above-market returns that did not vary with market conditions are the classic signature of fabricated performance, because real portfolios fluctuate and Stanford's reported results did not. The SEC's own internal review, conducted after the collapse, found that the agency's Fort Worth office had suspected the Stanford operation might be a Ponzi scheme years before it acted, and that examinations had flagged concerns repeatedly. The structural lesson from that internal review is about thresholds for action. Suspicion is not the same as a referred enforcement case. The smoothness of the returns was recognized as a red flag, but converting a red flag into an enforcement action against a large, lawyered, offshore operation required resources, jurisdictional reach, and institutional will that were not marshaled until later. What would have had to be true for earlier detection? Three things, structurally. First, the assets would have had to be independently custodied and independently valued so that the reported return could be checked against real holdings. Second, the auditor would have had to possess both the capacity and the independence to challenge the valuations of the illiquid third tier. Third, a regulator with both jurisdiction and capacity would have had to examine the actual composition of the portfolio rather than the reported summary. None of these conditions held, and because none held, the second set of books had no external check. A closed system that sets its own inputs and confirms its own outputs will reconcile indefinitely until something forces the assets to be tested against reality. That forcing event is the unraveling. The structural weakness of any operation that pays existing investors from new investor money is its dependence on continuous inflow. As long as new CD sales exceeded redemptions and interest payments, the cash flowed and the system held. The illiquid third-tier assets did not need to be sold, so their fictitious valuations were never tested against a real market. The vulnerability was redemption pressure. If depositors sought to withdraw faster than new deposits arrived, the bank would have to liquidate assets to meet the demand. And the assets being illiquid and overvalued, could not be liquidated at anything near their carried values. The financial crisis of 2008 supplied exactly this pressure. As global markets fell and a flight to safety accelerated, investors across the financial system sought to withdraw funds and reduce exposure. For an operation dependent on net new inflows, a wave of redemption requests is fatal, because it converts the gap between real and reported asset values from a paper abstraction into an immediate cash shortfall. The record shows that redemption pressure mounted on Stanford International Bank during this period. The SEC moved in February 2009. On February 17, 2009, the Securities and Exchange Commission filed a civil complaint charging Allen Stanford, Laura Pendergest-Holt, James Davis, and the Stanford entities with orchestrating a massive fraud centered on the sale of approximately $8 billion in certificates of deposit. The complaint alleged that the defendants had misrepresented the safety and liquidity of the CDs, the nature of the bank's investment portfolio, and the consistency of its returns. The court appointed a receiver to take control of the Stanford entities and their assets. The receivership is where the second set of books met reality. When the receiver took control and attempted to account for the bank's claimed assets, the gap between reported and actual became measurable. The liquid, verifiable assets recovered were a small fraction of the roughly $8 billion in certificates the bank had sold. The majority of the claimed assets, the illiquid third tier, could not be located, recovered, or sold at anything approaching their stated values. The receivership's recoveries amounted to a fraction of investor claims, and the structural reason is precisely the one the architecture predicted. The carried values were not real. When the assets were finally tested against a market and a receiver's accounting, the inflated valuations that had supported the reported returns collapsed, because there was nothing beneath them. The criminal case followed. In March 2012, a federal jury in Houston convicted Allen Stanford on multiple counts, including wire fraud, mail fraud, conspiracy, and obstruction. The jury found that the certificate of deposit program was a fraud built on misrepresentations about how depositor money was invested and how the bank performed. James Davis, the chief financial officer, pleaded guilty and cooperated with the government, and his testimony established elements of how the financial reporting was constructed. Allen Stanford was sentenced to a term of imprisonment of 110 years. The chief investment officer, Laura Pendergest-Holt, the figure present in the cold open scene, was charged in connection with the scheme. The record establishes that she pleaded guilty to obstructing the SEC's investigation and was sentenced accordingly. The convictions and guilty pleas closed the question of whether the operation was fraudulent. The jury and the pleas answered it. Pass. Trace the collapse mechanically because the sequence demonstrates the structure in reverse. The fraud depended on the illiquid assets never being tested against a market. Redemption pressure forced liquidation. Liquidation tested the assets. The test revealed the carried values were fictitious. Once the values collapsed, the reported returns that those values had supported were exposed as fabricated. And once the returns were exposed as fabricated, the entire premise of the CD program that conservative diversified investments earned the yields paid to depositors fell apart. The second set of books had reconciled perfectly for years, but only against itself. Against a receiver and a market, it reconciled to almost nothing. The SEC's complaint and the subsequent receivership reporting established the final accounting. Tens of thousands of investors had purchased certificates believing they held conservative, liquid, insured-feeling instruments. What they actually held were claims against a pool of assets substantially composed of illiquid, self-dealt, and overvalued holdings. The promised certainty of the certificate of deposit, its fixed rate, and its return of principal was the very feature that had kept depositors from looking past the rate to the assets beneath it. What does this case establish about the mechanism? It establishes that the certificate of deposit, the most conservative-seeming retail instrument, can be the ideal vehicle for fabricated returns precisely because of its conservative reputation. The fixed rate that makes a CD safe in a real bank is the same feature that suppresses depositor scrutiny in a fraudulent one. The depositor watching only the rate is not watching the assets. And when no one external is watching the assets can be whatever the books say they are. It establishes that illiquidity is not merely a risk characteristic. In a fabricated return structure, illiquidity is the enabling feature. Assets that do not trade have no price that contradicts the value assigned to them. The record shows that Stanford International Bank's largest asset tier was illiquid by composition, and that this illiquidity was what allowed the valuations to be set to whatever figure the chosen return required. Liquid assets are self-pricing and therefore self-policing. Illiquid assets are priced by whoever controls them. It establishes that the verification chain is only as strong as its most compromised link, and that an operation can be structured deliberately to compromise every link at once. Offshore domicile placed the bank beyond rigorous regulation. A small dependent auditor lacked the capacity and independence to challenge valuations. The absence of independent custody meant the parties reporting the returns also controlled the assets and their values. The commission-driven distribution channel was aligned to sell rather than to scrutinize. No single failure would have sufficed. The architecture required all of them, and it assembled all of them. As a direct result of the Stanford and Madoff cases, both exposed in the same window, the SEC undertook significant internal reform. The agency's Inspector General examined why the Fort Worth office's early suspicions had not produced timely enforcement, and the findings prompted changes to how the agency triages and escalates examination concerns, how it handles tips and complaints, and how it allocates resources to complex offshore matters. The structural lesson the agency drew was not about individual misjudgment, it was about the institutional thresholds that determine whether a recognized red flag becomes an investigated case. The findings of this review are these. A fixed return instrument suppresses the scrutiny that would otherwise verify the returns. Illiquid assets controlled by the reporting party can be valued to whatever figure the reported performance requires. A verification chain compromised at every link confirms only internal consistency, and internal consistency is exactly what a second set of books is built to produce. The day count Skim, the manufacturing of a coherent spread between assets and certificates that never existed in reality, worked for as long as the system controlled all its own inputs. It collapsed the moment a receiver tested the assets against a market that the system did not control. That is the structure. The returns were not measured. They were chosen. And everything beneath the chosen number was built to hold it up.